Hello, this is Tim Congdon. I'm chairman of the Institute of International Monetary Research at the University of Buckingham. This is the monthly update commentary on the global monetary picture. This video has been taken at the end of February 2020, when there is much concern, even alarm, about the coronavirus, COVID-19 coronavirus, spreading from China, with all sorts of worries about a global pandemic. This will have very major economic consequences. In the first week of February, car registrations in China were over 90% down on the same week a year ago, and such things as passenger bookings for cruise lines have also collapsed, not just in China, but all around the world. So there'll be less travel, there'll be knock-on effects to the demand for oil, and so on. Now, I'm not an expert on all this, but it's clearly possible that 2020 will see certainly a fall in Chinese output in the first half of the year, and who knows, unless a vaccine is discovered and developed fairly soon, there might even be a fall in world output because of this event. Now, I'm not an expert on that, and I'm not going to say anything further about it. It's just that what I try and do in these videos is to discuss the monetary influences on the world economy. And obviously at the moment, these are completely overwhelmed by what's happening from the coronavirus. However, there is a point I want to make, and it is relevant to government economic policy in 2020 and probably in the years to come. There's a widespread view that monetary policy is about the setting of interest rates to influence the growth of credit, bank credit, to the private sector. Sorry, that's not the whole story. It's also possible that banks can acquire claims on the government want to borrow from the banks, and this then has effects on the quantity of money and the economy. I'm just going to quickly, next few minutes, talk about banks and then bring it back to budget deficits and the monetary financing of budget deficits and what may happen in 2020 and subsequent years. Now, in my work, I concentrate on the quantity of money issued, mostly bank deposits, issued by banks, of course, and here we've got a picture of the balance sheet of a modern banking system. You can see the deposits on the liability side of the balance sheet, and then, of course, the assets must equal the liabilities, which means that the growth of the assets determines, or is equal to at least, the growth of the liabilities, and those liabilities dominated by deposits, in a sense, depend upon the growth of the assets. So that's the framework in which I'm talking about this subject. Banks must have some cash to repay deposits. Usually they're a very tiny part of banks' assets. And banks exist only to pay profits and dividends to shareholders. Some banks may be state-owned, but on the whole, in modern capitalist economies, banks exist to pay dividends to shareholders. That's why they exist. They don't exist for any other purpose. That's true, and I do all sorts of other things, but that's why they actually exist, to help the shareholders. So we've got the capital on the liability side of the balance sheet, and banks are inherently very highly leveraged. Assets are very safe with low returns, but the return on capital is high because of the gearing, the leverage, and they're also inherently fractionally reserved. The cash is a tiny part of the cash reserves, are a tiny part of the assets. So these organizations always will have quite a bit of risk on their balance sheets. Now, just be clear that the deposits are the bit of the balance sheet that I'm really interested in because they're money. When you get a change of 5 or 10% in the quantity of money, you get, roughly speaking, a 5 or 10% change in national income and wealth over time. Certainly when it changes of 50% or 100%, then these big changes are the dominant drivers of changes in income and wealth. On the other side of the balance sheet, you've got loans to the private sector. So when a bank extends, for example, a new overdraft to any of us, it adds a loan on the asset side of the balance sheet and the deposit on the liability side of the balance sheet, and the customer can spend the money against the deposit, goes to somebody else's deposit, and the loan is there as a persisting asset, paying, one hopes, interest and then profits for the shareholders and making the whole thing worthwhile. And in the last 60 years, this process of lending to the private sector, expanding the bank's balance sheet, expanding banks' profits and so on, has been the main part of the story of banks' balance sheet expansion and the driver of the growth of the quantity of money. But it's not the only kind of influence that can matter, because the banks can also hold claims on the government, or indeed claims on the central bank in the form of those cash reserves. And both the holdings of government securities and the cash reserves are claims on the state sector. This enables the state sector to conduct monetary policy operations. Quantitative easing was an example. But much more simply, the government may have a budget deficit that it wants to finance by borrowing from the central bank or also from the commercial banking system. And if you look at these charts of the assets of the American banking system immediately after the Second World War, you'll see that banks' claims on the government were much larger than their claims on the private sector. This, of course, reflected the government spending and budget deficits in the Second World War. Same picture true in the United Kingdom. So Britain had a very expensive war to finance, and the government financed it to a large extent by borrowing from the banks. And so the bank's assets were dominated by claims on the state. Now, how does this matter to early 2020? It's very likely, this is the first point I want to make, it's very likely that the coronavirus will give governments a pretext for increases in the budget deficit. Obviously, there's likely to be increased health spending, hospitals and so on to deal with the patients, but also there's going to be spending on drugs and medicines as the vaccines and so on become available. So that on top of that, there is at the moment a downturn in the world economy, not caused by demand weakness, caused by supply side disruption, but all the same, governments will take this as an excuse for increasing spending, possibly cutting taxes, and so, as they see it, stimulating the economy to get us out of the current hole. Okay, but on top of that, let's be clear that at the moment, we've got large budget deficits in the USA. We've got a budget deficit that is something like $1,000 billion against American GDP of around about a bit over $20,000 billion, $20 trillion. But this deficit is taking place in peacetime and also in period of prosperity. So it's unusually high, and this will to some extent need to be financed from the banking system. That then means faster monetary growth. This is a positive for economic activity in the short run, not good for inflation in the long run. In the UK also, we have talk about an increased budget deficit coming up the next few years, with Boris Johnson allegedly an enthusiast for large infrastructure projects. And we've got a budget coming along on March the 11th, where all the talk is about the new Chancellor, a chap called Sunak, being in favour of some relaxation of the fiscal rules that bound his predecessors, and including, of course, George Osborne and so on, who for all his faults did reduce the budget deficit in the UK between 2010 and 2016. So what we've got in a number of countries at the moment, Japan's another example, is large budget deficits which are being financed to some extent from the banking system. And I think this is going to be one influence in coming years that will tend to raise monetary growth, add to banks' assets, then add to banks' deposit liabilities, and so, in some sense, being positive for demand in the short run, but also potentially being a risk towards inflation in the long run. To conclude, one of the problems here is that this is all taking place in an intellectual vacuum. There is no clear guidance from officialdom about the planned rate of growth of the quantity of money that central banks and the governments want to see. No indication either of the extent to which the growth of money is to be driven by lending to the private sector rather than this monetization of the budget deficit, which can sometimes be enormous. And so to some extent we're in the dark about what happens in the future. But I think what I'd be expecting is for 2020 possibly a very weak world economy because of these effects of the coronavirus, and then a big rebound in 2021, maybe 2022, as the coronavirus pandemic fears die down and vaccine emerges and so on, and we see a really big rebound in 2020, with possibly this monetization of the budget deficits being an important part of the story. Thank you.